All right, guys. So, I mean, this is going to be the same presentation I did last year, but I don't think any of you were here for that. So that's probably pretty good. Basically, just navigating your taxes. This is kind of for everybody, but it's geared a lot towards real estate agents specifically because real estate agents kind of have the most fun with the tax code this year in terms of what's available in tax savings. And it's not just limited to real estate agents, but real estate professionals, let's call it. So this is me. If this would work, that would be great. There we go. Just a little bit about me real quick. This is a little too much, but I come from New York. I wasn't always doing income tax. I was kind of in the medical industry before this. I worked in ophthalmology clinics. I worked in physical therapy. I started doing tax because I did accounting in high school. I did an internship, kind of worked out, fell into my lap, and it kind of all went from there. And I just say that to say that I've had experiences with different industries, so I'm able to relate to all of them really well in that sense. Like I've just learned to kind of navigate and ask you the right questions to understand what you're doing and where we might be able to find some help for you. So, I mean, that's mainly about me. I don't think you need to know much else than that unless you'll have questions for me, which we'll address them in the end. I do some real estate investing on the side myself as well. So I think that plays into understanding what you need a little bit better from, where we are right now, which is kind of real estate perspective. This is what my firm does. I deal with individuals. I deal with small businesses. I do IRS representation. So that's for people mainly who are getting tax notices or they have very large bills and we have to strike a settlement for them. This type of thing happens all the time. So I do that as well. Tax advisory and tax planning. You don't have to work with me, but you do want to have somebody like me who isn't just working at tax time and then sending you on your way until next year. You want somebody who's going to speak to you year round. If you are self-employed, you want to be talking to somebody at least every quarter, if not every month. It's very important because tax code changes. Obviously, with the new president, we're expecting that that's going to change as well, or at least he's going to build on what he did before. And then also your life situation changes. Maybe you move, maybe you get married, divorced, kids, and so on. More income, less income. So that's that. Like this is going to be really geared towards the self-employed. So very important when you're self-employed is deciding, first of all, do I need an entity, meaning an LLC or a corporation? Second of all, if I do decide that I need one, why do I need one? And which one do I need? What kind of records should I be keeping as a self-employed individual, whether I have a company or not? What can I write off and how can I pay less taxes? These are usually the questions that should be at the forefront of your mind when you're going through your stuff. So this is how entities work. There's two actual entities if we exclude trusts, because I don't really deal too much with trusts. LLC and a corp or a C corp. S corp is something that everybody always hears about, but it's actually just a tax status. It's not a type of company. It could be applied to an LLC or it could be applied to a C corporation. Okay, here's the differences. If you're just self-employed, you work on a 1099, nothing else, you're considered to be a sole proprietor. Sole proprietors pay federal income tax and they pay something called a self-employment tax. Self-employment tax is what covers your Medicare and Social Security deposits. Because you're not having a regular W-2, nobody's taking that out from you, but obviously the government needs their chunk. When you go to a corporation tax status, the profits from a corporation are not subject to self-employment tax. So usually that's why you're going to get pushed into doing something like that, taking the S Corp status or opening up a C Corp, again, because you're avoiding the self-employment tax. Because you avoid the self-employment tax, the IRS has a backup to make sure they still get their money, which is when you're in one of these statuses, S Corp or C Corp, you're the owner of the company that provides services to the company, which is common when it's just you, right? You have to pay yourself something called a reasonable compensation for the work you do. That's going to be on a W-2. That's how they get their Medicare and Social Security taxes back. I say all this to say, don't just jump into something because you heard it at the hairdresser or you heard it at the supermarket or whatever. You really need to speak to your professionals and figure out which is right for you, if any of them are right for you right now at all. Tons of people jump into this. They end up spending a bunch of money on it. They don't really need it, A, or B, it ends up being a burden to them to begin with. So that's kind of entities. Any questions before I move on this stuff for now? Everybody kind of gets it? We're all good? All right. And I know I'm kind of speeding through a little bit. I talk fast, so just slow me down if anything. This is write-offs. So just because something is a write-off doesn't mean that you can just write it off. The expenses that you incur when you're self-employed, that's the benefit of being self-employed, is that the expenses, you can use them to reduce the portion of your income that's taxable and only pay tax on the remaining profits. So it's very beneficial versus somebody who is just employed on W-2. If I'm on W-2, I can't deduct any of my expenses, even if I incurred them to perform my work, whether I had to buy my laptop or I have a home office or things of that nature, licensing, insurance, things like that. When I'm self-employed, anything that I need to spend money on that's ordinary in my industry for the level of service that I'm providing and necessary to keep my business going. So that's most important, is ordinary and necessary. The people who are buying, a Lamborghini and saying that they can write the whole thing off just because they need a car to get to their clients, it doesn't exactly work that way. If you're getting like a Prada laptop sleeve versus a regular laptop sleeve, that's not so much justified because it's not necessary. Your laptop will be protected with the $20 Amazon case. So that's things to keep in mind. These are just some ideas for things that can be deducted in terms of grouping, because some things just don't click sometimes. When you're spending money on it, you don't end up deducting it. So advertising and marketing, computer services and software. So even if you use something to keep track of your income and expenses, that would fall under that. So like QuickBooks, for example. Continuing education and conferences, I think that one's kind of obvious. And by the way, that includes any travel, meals, incidentals incurred when you travel somewhere away from home for that. Dues and subscriptions, also I think pretty self-explanatory. Office expenses, office rent or home office, you cannot do both. So home office you can deduct if it's the primary place from where you perform your work for your business. You can't double dip on both of them. Employees and contractors also obvious, and travel and meals obvious as well. One thing to keep in mind with meals that's important is if you are on the road going to different showings, for example, as a realtor, and you stop off to grab yourself a bite for yourself, that's not a deductible meal expense because you would have had to pay for food for yourself anyway to eat during the day. But if you're going out with clients or you're going out with your lawyer or your accountant, specifically talking about things that relate to your business and promoting your business, then you can have a deduction for the money that you spend on the meals, half of which is actually deductible, 50%. Some kind of things to keep in mind there. I think that's all for this screen. Depreciation. Okay, so
I have a question.
yes. Yeah, what's up?
If it's like an open house, you gotta buy like food or
Yeah.
or you can write that off, right?
Yeah. If open house is part of your business and this is what you do and you bought some things to get people there, yes, you can. In fact, that's 100% deductible, what you buy for that. It would be the same thing if you like have like a stand at a conference or something like you're sponsoring, anything you purchase for that also would count towards that. Or if you're doing like, you're at the flea market, but you're promoting your business, that would count as well. So depreciation, I generally bring up more for rental real estate, but it does apply to self-employed individuals also. Like if you purchase a vehicle to get around to your clients, for example. Here's what depreciation is. When you buy an asset, whether it's a house or a fridge or a car or anything tangible like that, the IRS assigns a useful life to it. So they say basically, this is how long this thing should last before you have to do significant renovations to it or get rid of it altogether in exchange for something else. So for example, a residential property, 27 and a half years is the life that they give to that. A vehicle is 5 years. Laptop computers, I believe 5 years as well. And the list goes on. They have a life for everything. What that means is when you are reporting these things on your tax return, let's say you purchased your car and you use it 100% for business. You don't do anything else with it. You just use it to go to your different clients and whatever. You break down the price by 5 years. Every year, that's the amount you're able to take as a deduction against your income. plus the interest you pay in your finance, plus your gas, plus your maintenance, plus your insurance and all of that. Okay, so instead of, if you bought a car for 50K, instead of deducting all of that in the first year, the basic standard way that you do it is $10,000 per year is what you would deduct there for argument's sake. There's caveats, but for argument's sake, that's that. This is important in real estate as well, and I'll kind of circle back to why. But before I do, I will mention the accelerated depreciation portion of this. So TikTok, right, is all about Section 179, bonus depreciation, buy yourself that G-Wagon, it's over 6,000 pounds, and deduct the whole thing in the first year. There's times to do it and there's times not to do it. First of all, bonus depreciation, if I'm not mistaken, this is the last year for it. There's two ways to depreciate something in an accelerated way. There's called Section 179 and there's bonus depreciation. Bonus depreciation is what all these guys who do the videos online have been doing. They buy that G-Wagon, it's over 6,000 pounds, they say they use it all for business, and the entire 100K or 150K, however much it costs, they deduct it in 1 year. They take all their depreciation up front. You're allowed to do that as long as you are using the car for business. Here's a drawback. If I take all of my depreciation expense this year, what am I going to do for the next 5 years, next 4 years of the useful life of that car? I'm not going to have an expense to take. So if this wasn't a crazy year for me where I made, like triple the commissions I normally make, or I didn't have a business that I sold and I have a huge profit to report, or like capital gains on a house, I don't think it makes sense for you to do that accelerated depreciation because you're kind of shooting yourself in the foot for future years. Also, these guys will tell you, I'm going to sell my G-Wagon at the end of the year, I'm going to get a new one next year and deduct it again. It doesn't work that way. When you take a depreciation expense, it lowers what's called your basis, how much that car cost you on paper in that car. So when you ultimately sell it, the profit you're going to recognize is going to be much higher. I'll give you an example. I buy a car for $100,000 today. I take the depreciation expense for half of the cost of it, for $50,000 this year. Next year, I decide to sell that car. When I sell that car, the way I'm going to count the profit that I made on it is $50,000 as my cost versus how much I sell it for. The chances that your car actually depreciated 50% in the first year is unlikely. It's usually 15 or 20%, like at most. So that's something to keep in mind. You have to recapture that income and pay taxes back on it, which is why those strategies don't really work well usually. That's the recapture upon disposal portion. And that applies to houses, that applies to cars, that applies to really anything. Usually though, like with a computer or a phone, you're just kind of tossing it because it's not worth anything to you anymore. Even if you are selling it for something, you're likely not selling it for a profit. You're just recouping some of your cost. So that's that. We good on this so far? All good? All right. Record keeping tools. I mean, I'm sure you guys are familiar with this. I'm usually using QuickBooks for all of my clients. For a few of them, we use Xero, and I think for one of them, we use Zoho because they also use their CRM tool. Wave is really good, I would say, for beginners. So if you're just getting started out, I believe they still have a free version, if I'm not mistaken. That's pretty good. But even with QuickBooks, they're not that expensive, and it's very easy to use, and they'll take care of a lot of things for you. You can upload your receipts there. You can track the mileage that you drive in your car to back up your vehicle deductions. And all of them should offer that. But just some ideas of what you can use. And there's plenty of them out there, especially these days. Strategies for tax savings and sheltering. I think this is what everyone is here for. So proper choice of entity. Like I said, it could be really good for you. You can also end up causing yourself a huge burden. The example I usually give is when you go from the LLC structure to the S Corp structure, your costs increase drastically because you have to keep a tighter set of books. So you're probably usually hiring somebody to do that for you. You have to do payroll for yourself, the W-2 that I mentioned. There are costs associated with performing payroll. I would say on average, it's like $500 a year to do that. And you want to move to that next entity tax structure if your tax savings are going to exceed all those costs, plus the headache it gives you, plus any psychological aspect of it, because some people just won't do it because they think it's too much of a burden and it's not worth it for them, which is fine too, if that's how you are. So that's proper choice of entity. You could end up saving a ton of taxes though.
And when you're saying change it? Is it like from LLC to a S corp?
Yeah, so remember, the LLC is your entity, and S corp is going to be a tax structure you attach to that entity. And you would do it essentially when your profits in the company are so high that the costs you incur to go S corp are exceeded by the profit, the tax savings, excuse me. Generally, your profits should be 100K or more to consider going S corp, give or take, depending on the industry.
Okay.
How's it going?
Hi. Come sit down.
You want me to stop for a sec, or are we good?
So your profits should be above 100. It's not your gross.
So when I say profits, I mean after you've considered how much you're going to pay yourself, whatever profit is remaining, you want it to be in that range because you want your tax savings to exceed the cost generally. Again, it varies. It could be for some industries 60,000, for some industries it might be 150,000, or S corp like might not make sense at all. So yeah, but yes. Yeah, like.
About proper choice.
Yeah, like with tax structure and everything. And like with you, you were mentioning S corp before, so it's fine if you do it too early too, if you're kind of on the right track and you're on top of things. What you would want always to get is an analysis, like, hey, if I was just a LLC this year, what would be the total tax I pay versus I'm an S corp this year? What is the total tax I'm paying? You can always revert back if it makes more sense. You can go back and forth easily. You can go S corp very easy. You can go back to LLC once very easily, but then there's a 5-year waiting period before you can go S corp again. So you really want to make sure that it's the right decision for you. And those are usually pretty easy things to calculate if you don't have like a ton of different businesses and a lot going on. So that's proper choice of entity. Tax deferred accounts is going to be things like your 401k, your Roth IRA, your regular IRA, your HSA. HSAs are a very, very good tax deferred account. They're possibly one of the best if you're eligible for one. That also falls under tax advantaged accounts. Actually, I don't even know why I put both of those there. Accelerated depreciation we spoke about, so sometimes it does make sense. You had a huge year, you got a ton of commissions, you're in a way higher tax bracket than you would normally be. In that case, it may make sense to make that big purchase that you were going to make anyway and take the accelerated depreciation on to get yourself that extra expense on your books. Tax loss harvesting it works for some people. So here's what tax loss harvesting is. I buy stocks. I have stock holdings in my portfolio, regular, in a taxable account, not in a retirement account. And for some reason, towards the end of the year, the stock market is dipping and dipping to the point where that specific stock holding that I have is in the minus. What I would do is analyze that in November, December. I would sell my shares, take the loss, and just reinvest that money to something very similar. So when you're investing in like blue chips like Tesla or Apple or Microsoft, you're not going to do that generally because you're in that company because you love that company. But if you're investing in like an S&P fund or some sort of ETF, there's a ton of different ETF managers that kind of do the same thing. So you can flip-flop between one and another. What that does for you is allows you to realize the losses and take them as an expense on your tax return to an extent, but it could help. That's if you have a financial advisor, that's who should be helping you with that. But if not, you would probably talk to somebody like me, show me your statements, and I would give you advice just from the tax perspective, not from the financial perspective. Hiring your kids. It is a TikTok strategy, but it is a good one for some people. It works best in the LLC structure only, and I'll explain why. So first of all, you can't just hire your 1 or 2 year old and just say that they're on payroll when they're actually not. With 1 or 2 year olds, it really works if they're like a model for your advertising. Otherwise, it's not going to happen. They do need to be performing services for you. So if you have like an 8, 9, 10 year old who is doing some administrative clerical things, I think that makes sense. Yeah. I have clients who use their kids for like if they're an occupational therapist, physical therapist, and they're working with other children, they might use their kids to help with the playtime and help organize things, help clean up afterwards, like easy things to do because it could get messy in those rooms. Here's how it works with Hire Your Kids. Again, LLC structure is the only place I would do this. I would not do this in a C Corp or an S Corp, and I'll explain why in a sec. So I hire my 12-year-old kid, for example. They're helping me do clerical work, however many hours per week for the year. The goal, you might not always hit this goal, but the goal is to pay them up to the amount of the standard deduction on a tax return. For 2024, that was 14,600. Here's why. When I pay them, I take that expense on my business. It reduces my taxable income. Because they're below the standard deduction amount, the 14,600, they have no liability to pay taxes. So now I've taken a tax deduction, I've shifted my income to them. They don't have to pay taxes on it. And on top of that, because they now have earned income, they can invest their money into a Roth IRA. Yeah, what's up?
Okay, I think I need to do this year, but with the older ones anyways. So that income that is coming in for them, I can, as their guardian, put it like in a Roth IRA for them or something.
Yes, a custodial account, exactly.
Okay.
Exactly. So to put it into an IRA, they have to have earned income. So this has to happen. It can't just be you giving them a gift, right?
Right.
Has to be all on the books on paper. But yes, you can do that up to the limits, so up to $7,000 per year per kid right now. However, this does not work well for kids over the age of 17. Because once they cross that, they have to pay Medicare and Social Security taxes, and you do for them as well.
Okay.
The reason it doesn't work well in an S Corp or a C Corp for any kid is because from day one, you have to pay Medicare and Social Security taxes on them. So it could still end up benefiting you, just not nearly as much as it does in an LLC
Got it.
with those layers. Make sense?
Yeah. And then
So-
if you had a kid that was like under 2 and they're in your marketing material, can you hire them as a model like that?
You can. I just strongly advise to see what the going rate for child models is in your area for what you do, and just make sure you don't pay them much more than that, because you'll get clipped on it, I think.
Okay.
Yeah, it's important to, yeah.
Maybe like if I do hire the kids to help with like admin stuff, just keep track of their hours.
Yeah.
You
That
know,
literally just
like you're keeping track of their pay.
just like there were any other type of employee. You keep a log of their hours, and that's it. Yeah. That was hire your kids. Okay. Cost segregation. I mean, this is a huge one for real estate specifically. Here's what a cost segregation study is. So I covered depreciation earlier. You buy an asset, it has a useful life set by the IRS. Every year, you take that portion of deduction against your, let's talk about a residential rental property. You take it against your rental income on top of your mortgage interest and your property taxes and your maintenance and HOA and everything else that goes into it. Here's what a cost segregation study does. So when I buy a house, the house has a 27.5-year useful life, and that includes everything in the house. It excludes the land. We can't count land in that depreciation expense. By the way, that's one huge mistake that accountants make, or people who self-prepare their return. They never take the land cost out of the cost of the purchase before doing depreciation. And that's something that you will slide by with for 10 years, and then they'll come after you all at once for all of that to get it back. And usually it's not that big of a deal, but it's still annoying. And it opens you up if you have any other kind of shady things on your tax return for them to find. Here's what cost segregation does. So the house has a 27.5-year useful life, but your appliances, your wiring, your plumbing, your flooring, your kitchen, your bathroom, they don't. They have a shorter useful life than the house. They're going to be 7-year property, 5-year property, 15-year property, the roof. What a cost segregation study does is it breaks that house down into all of these various components. So if you bought a place for $500K, you may end up only using 250 of it on that 27.5-year life. The rest of it is going to be on the shorter life. The reason you want the shorter life is because you get a larger deduction every single year because you're dividing by a smaller number. In addition to that, if you're in one of these, high income years with all the other stuff that you do, or you sold a house for a lot of money and you didn't, 1031 exchange it or something, you have this big gain, you can accelerate depreciation on those other things that are 15 years or less useful life. That's why cost segregation studies can be very, very beneficial to you. They should really never cost more than $1,000. They could save you way, way more than that on your taxes. Again, especially if you're in a high income tax bracket. If you're not in a high tax bracket and you're kind of just I would say, I don't know, 100K a year income, you have a rental property on paper doesn't turn much of a profit. I might not even do the cost segregation study and let you spread out your depreciation over those 27 years because you don't really need to go higher than that. But when you start getting into that 250, 350, $500,000 income range, this could save literally tens of thousands of dollars in taxes in the first year, just on one property. If you own multiple properties or you got other investors you're working with and you're getting bigger properties, you know, the bigger it is, the higher the deduction can be.
When does that 27 years start?
When you put the property into service. So like, let's say I own my own house and I live in it as my primary residence for 2 years, and then I decide to move somewhere but keep it and put it into service for rental, that's when it starts.
So regardless of the age of the home?
Doesn't matter.
Doesn't matter.
Yeah, it doesn't matter, but it's not going to be at that point just how much you bought it for. If you've done renovations, if you've done improvements, these things are going to add on to that cost as well that you divide. And as you go on and you have to, you know, in between tenants, if you have to do a major remodel, something structural, you will depreciate that as well. That will add on to that as well, and it'll keep going that way until you sell the property. But yeah, it's whenever you put it in service. That's the rule. That's when the clock starts. 1031 exchanges. These do not work on primary residences. That's really important to keep in mind, but they do work on investment properties. The rule is you're selling an investment property and you don't want to pay tax on capital gains. If you're going to have capital gains here, you don't always. You almost always do because of depreciation, and the depreciation lowers your cost in that property, so the profits become larger, like I was mentioning before. And so a lot of people want to avoid capital gains tax. So if you don't need the money in your pocket from the sale of that place, you're going to reinvest it anyway. That's what you want to do. You want to do a 1031 exchange. You sell property A and put the money into property B. You defer your capital gains until you ultimately dispose. Generally, the logic is never dispose. Keep 1031ing into something bigger, into something bigger, into something bigger, and so on. Unless, again, you really need the money. And even in that case, you might see that there's more value in doing like a HELOC or something and pulling money out of that house, or, you know, doing something else to get money out of that place. Leverage your home. Important with 1031 exchanges. I can't just go sell my investment property, receive the proceeds, and then go buy another property. It has to happen through an agent, through an intermediary. That's very important. You have to have the new property lined up within 45 days of selling the first one, and you have to have closed on the new property within 180 days, within 6 months. Yeah, that's very important. If you go a day over that, you're disqualified completely from that exchange, and you got to recognize the proceeds on the sale. Also, the new property has to be, first of all, of like kind, so real estate for real estate, residential for residential, and it has to be of a higher value than what you sold. That's important as well. So a couple of things to keep in mind, but these could be very beneficial for investors. Withholding checkups. So kind of interchangeable with estimated tax payments, quarterly estimated tax payments. So withholding checkups, I usually say to people who are on W-2 only. The problem oftentimes is, especially with the way that withholding taxes work today, the grids, if you have one job, you're usually good. If you have two jobs in the household, even if it's you and a spouse, or you're working two jobs, spouse doesn't work at all, or you switch jobs during the year, or you receive commission pay or bonus pay, there's a lot of different caveats, you're gonna find that you end up underpaying your taxes for the year, and you got a huge tax bill at the end of the year that you were not ready for. For that reason, with my clients, I always tell them, once at tax time, once in October or November, give me your pay stubs, tell me the rest of your situation in the household financially. Let's run the numbers, make sure you're on track with your tax payments to make sure that you don't run into either getting a huge refund, which you don't want, or having a huge tax liability that you weren't ready for. That's what withholding checkups will do. With the self-employed individuals, it's a similar idea, except you're not paying any taxes throughout the year except what you physically put in yourself. So usually on a quarterly basis, we'll take a look like, okay, this first quarter you made $30,000, that's your profit. This is how much in tax you should prepay to the IRS. Second quarter comes around, we look at the first 2 quarters together and see where you're at, and so on until the end of the year. Again, that prevents you from overpaying taxes, underpaying taxes and having a huge bill, and running into any penalties for no good reason. So that's what withholding checkups would be. And then the real estate professional status. So this is kind of like what I wanted to jump off with, which is what this is for. Real estate professionals have the most fun with the tax code because it's most open to them to utilize to their benefit. So generally speaking, when you go and purchase investment property, the goal is that on paper, you're showing losses every year. The reason you want to show losses is, first of all, so you don't pay taxes on your rental income. And second of all, so you can offset your other income in the household to bring it lower and pay less taxes on that. The problem is that rental, especially long-term rentals, are considered passive income to you. And passive income has limitations on the losses you can deduct using it. The limitations work like this. If you don't materially participate in the property, meaning you bought the property and you have a management service take care of everything, all you do is collect those checks and file your taxes at the end of the year, you cannot utilize any of your losses to offset your household regular income, whatever else you got. If you materially participate in the property, so you're putting time in, you're actively working in the property, you're, working on the renovations, you're dealing with the tenants, you're dealing with the realtors, the contractors, etc., running the books for it, then if your income is under $100,000 for the household, doesn't matter if you're married or not, then you can deduct up to $25,000 of your losses. If your income is between 100 and 150, that amount gets halved. And then if your income is over 150 for the household, then you can't take any of your losses at all, your passive losses. What the real estate professional status does is it unlocks that and lets you recognize your passive activity as an active one, just like a regular business. Your losses become unlimited. So as long as you have them, and this is where you leverage the cost segregation and the depreciation expense, you can offset your income down to zero if you have enough expenses to do that with.
You're just talking about the rental income purely.
Yes, yeah, exactly. And your real estate work in general, yes.
Oh, in combination. Okay.
Yes.
What counts as your losses?
So take an example, like you have a property, you have tenants in there, they pay you $1,000 a month in rent, you have $12K in rent for the year. Then you have a mortgage, right? So mortgage interest, you deduct on that off that rental income. Let's say it's $1,000 of mortgage interest. Then you have property taxes, you have your management dues, HOA dues, whatever you got there. Most likely, usually, especially after the first 5 to 10 years when your mortgage interest is getting lower and lower, you're gonna still turn a profit on that property, right? With depreciation of the place, you're likely gonna bring yourself into the losses. So again, reducing that rental income into a loss. And then you wanna be able to use that loss to offset your regular work. So if you're a realtor, or if you work even in the supermarket, doesn't matter what you're doing, you may be able to offset your regular income if you can satisfy real estate professional status. I believe I had another slide on this. Yeah. The other thing, by the way, that having that status helps you avoid is this is for higher income earners. So when you make, I believe for single people, it's over 200K a year. For married couples, it's 250K a year. There's another tax that comes into play on your tax return, which is called the net investment income tax. And what that is when you're over that threshold of household income and you have passive activities from which you're making money. Hello. You can cut across. It's all good.
Hi, Melanie.
Ooh, yes. Sorry, I didn't mean to.
You're good. I guess we should have waited. Huh?
No.
Oh, okay.
No, 'cause it's so much fun.
Yeah, I was.
Yeah, I'll be done in a few minutes. This was kind of the bulk of it, so I'll be done soon too. Net investment income tax is 3.8%. That's going to go on any passive income you have. So like if you receive interest from a bank or dividends or even your real estate, the passive portion of the income, residential real estate. Again, if you're over that 200 or 250K income threshold for the household, this adds on, and at that level, you're already paying, 25+% in income tax, and this is just going to tack on to that. By being a real estate professional, it makes your rental income active So if you do show profits there, it's not going to be subject to that net investment income tax. So that's important to help you avoid that. You do need to materially participate, meaning you do a lot of the work yourself. It has to be 750 hours a year of real estate work. And I don't mean just working on your rental property. It could be showing and selling homes. It could be dealing with banks, dealing with lenders. It could be anything involved with operating real estate. It just can't be your travel to the real estate itself.
Do you have to be a real estate agent?
No,
Licensed?
no.
Right, as long as you're operating.
As long as you're operating the right way and you keep a good log of this, then you're good. The last thing is that even if you put in the 750 a year, it has to account for more than 50% of all the work you do all year. So usually someone who's like a full-time employee somewhere, they're likely not going to be able to qualify for this unless they're working like 20 hours days all the time.
Track those 750 hours.
You should, yeah, because they'll scrutinize it. They're going to want you to have a log of the things that you did. So I went today to show these 3 houses. I had an open house. Then I went to my rental property to, I don't know, clean the leaves or something. And
Just say 8 to 5, Monday through Saturday.
you could say that when you file your tax return, but it just won't. It wouldn't hold under
You
audit.
need to break it
And
down into the actual.
yeah, in the unlikely event of an audit, you're going to want to have like everything broken down.
What, I mean, if we're a real estate title company, I mean, does that fall? I mean, we're in real estate, everything we do is in real
I actually don't think that what you do falls under that. I need to double check that,
Yeah.
as a matter of fact. But I don't believe that what you do in here for that anything that you do with like staging or interior design, things of that nature, that might qualify. But I don't think title work does. Actually, yeah. But sorry,
I'm gonna ask him. See if you can find out.
I will. No, I will make sure.
Sounds like an opinion.
I should know this.
Yeah, I think this sounds. I think what you do is absolutely real estate related.
I'm a real estate professional.
That's right, highly professional, maybe the most.
I read contracts.
This is a good TikTok to tell other people what not to do. No, that was it actually. So I mean, I'll take Q&A if you guys have any questions or anything you want to ask, or you can always reach out to me after the fact. I don't charge for questions just like that. You can always call.
Maybe some clarification on S corp usage and times when it's back. So you were referencing before about hiring your kids bad for S corp, obviously
Yeah.
because you're paying those additional.
The Medicare and Social Security, the FICA. Yeah.
Yeah, I guess in general too, if you have additional, like, say for example, you hire your spouse to do something like that too, any other additional work under the S corp, with all that considered, maybe in better situation is to just maybe not have them it's not worth it unless it is an LLC as a structure.
I would say that when you yourself are kind of in a lower income tax bracket, that S corp doing it there might not make sense because you're not going to see enough tax savings to offset paying those FICA taxes on the kids. But if you're in a higher tax bracket, so I would probably over like the 22% bracket or 24% bracket, then it would still make sense to do it in an S corp. It's just less beneficial.
Okay.
All right, yeah, so oftentimes people might revert back to LLC, or they may have another LLC that they operate ancillary to what they're doing in the S corp that will shuffle the funds around legally, of course. Where again, the work has to actually be done.
You have your marketing team, which is going to be your child and your dog.
Sure.
That both are getting paid for their marketing purposes.
Minus the dog, of course, but yes.
Obviously.
Yeah, absolutely. So there was something else about the S corp you wanted to know, or was it was specifically for that stuff for children?
Maybe just specifically, I have a beautiful young baby girl,
So cute.
but I imagine she's going to be doing some modeling work for the business. Or something.
Yeah, my best recommendation is look, do it if you're willing to face the consequences from her when she's 18 and hates you that you did that. But what I really want to say is make sure that you're paying a market rate
Oh, yeah.
for what a child model might get for the amount of modeling that's being done. So it'll be one thing if it's for like a flyer, another thing if it's for a website, another thing if there's like a real ad going on. So just keep that in mind. Do the research because that could bite you in the ass for sure.
Oh, of course.
Yeah, but otherwise you're definitely good to do it. And look, all that aside, it's a great way to invest for their future because you have the Roth IRA that opens up for you.
Yeah. So basically, if you're, I mean, you're adding, it was 7,000 a year, if I'm not.
Right now it's 7,000, yeah. Yeah, which, compounds over the years, plus the gains are tax-free and all that, so it could be really, really good for them, even if it's to ultimately pay for college or a wedding
You can
or.
also trade out of a Roth, I think, too, right?
You can trade, yeah. And here's the other thing about the Roth is that when you contribute directly to a Roth, you can pull the money you contributed out at any time, free of consequences and free of tax. So it's like a kind of rainy day fund in a sense as well. You don't want to pull out the gains in there, yeah, but you can pull out what you put in if you have to. So yeah. So again, you're investing for them under their name, and maybe some expense comes up, extracurriculars, whatever you want to be doing with them, you'll be able to pull that money out and use it if you wanted to. Yeah, really, really powerful tool. It's like one of my favorite ones, I would say. That and the HSA as well. But you have to be eligible for an HSA. Do any of you have an HSA?
I used to have one, but isn't it like now you have to make a certain income to qualify?
No, you have to have a certain deductible. You don't have to make a certain income.
Okay.
So I believe it's a $2,000 or higher deductible with your health plan to qualify for an HSA. Then you can contribute money to the HSA. It's pre-tax, so you get a tax benefit for putting the money in there. It's not a lot every year, but it's something that's like a little over $4,000 a year for an individual. But you don't have to use that money. You don't lose it if you don't use it by the end of the year. And you're able to invest it the same way you would like a Roth IRA. You're able to put it into mutual funds or stocks. The growth in there is technically tax-free as long as you ultimately use the money on medical expenses.
I'm gonna ask you kind of a complex question around that.
Yeah.
Like in a divorce situation.
Okay.
Okay, so if I know we have, every year we choose a high deductible plan for the kids. So, but the kid's dad carries it in his name and I pay half of the premium. So we both are contributing to his insurance for the kids.
Mhm.
If it's a high deductible, do you know if I still qualify for the HOA, the HSA benefits, if I'm still paying half of the premium, but it's not under my name, but it's for my children?
If I'm not mistaken, they would have the HSA, but
Yeah.
the kids would, but they would also have to have earned income to contribute to it.
Okay, so whenever, like, when I hire them,
Mhm.
I can either contribute to the Roth or the HSA?
Or both, potentially.
Yeah, or both.
Potentially,
Okay,
yeah.
that's fine. Okay,
Yeah, because you'll likely be paying them enough to cover the maximum limits on both of them.
Yeah.
Again, if you can afford to do it, and if you want to do that, yeah, absolutely. Yeah, and with HSAs, the other tip I'll give, if you have one now or if you ever have one in the future, is you don't have to use the money today. Save your receipts from today. And there's a crazy long list of what qualifies for HSA spending, down to over-the-counter stuff from the pharmacy. So, and there you can Google it. It's very easy to look up, or your HSA plan will give it to you. As long as you stack up those receipts, ultimately, when you need to take the money out of there, you could just withdraw it. You don't have to prove anything to anybody as long as you've already spent it on the right things. You won't pay taxes, nothing. But the key is invest it, in my opinion. Yeah. What else? Are we good?